Hello, my name is Eddie Topic. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. Now, my apologies here for making parts of this daily chart look like a rainbow, but those multicolored lines are necessary. And I will shortly explain them, so please bear with me. Okay, so there is a pattern in operation that I've highlighted since last summer, and one that still needs highlighting. You see, some while ago I had pointed out the cat's ears pattern over June and July 2023. In essence, this is a double top formed in an overall downward moving market. Potential below for such a cat's ears pattern is target X2 down in the 502 zone, and that potential is still there. For a while, during autumn, it looked like we would never get there, but since late November and especially December last year, the market gradually started to approach this potential pattern target. In March this year, we had the closest so far approach towards target X2 down to the 38.2% absolute Fibonacci line at 521. And this is where the idea might have come unstuck, as this 38.2% absolute Fibonacci line saw a rejection in March and a climb up and away. Now, prices have pushed up over the bright red highlighted March 2022 to date broken downtrend, currently at 515. Most recently over the bright green highlighted upper time, currently at 558 of the broken and maybe repaired late December 2023 to late January 2024 bearish shift pitchfork. And even for a while over the short medium moving average, currently at 569, which had reinforced the upper time since February actually. However, the market did not lose contact with the upper time and has been traveling on the top of it, the upper time, for the last few weeks. So I'm minded to still keep the bright green tine in operation, and the thought and spark of the idea of a move down to target X2 at 502 still alive for now. But also for the moment still keep the bright red downtrend on my daily chart for the same simple reason the bright green pitchfork is there, that it had in the past, especially the downtrend being excellent, showing the recent bearish angle of attack. Now, this is where the extra colors come in. In the recent rise from potential V bottom, we saw some significant resistance overhead from the flatlining medium moving average, currently at 591. This is currently at the March 2021 low at 592. However, better resistance was and is further up at the combination of the July 2021 high at 609 and the declining long moving average, currently 608. Between these two areas, we saw considerable congestion between September and November last year, and again in mid-January to mid-February this year. So it's not as deserted as it may first appear. And thus, we have seen these past 2 weeks a decline, enough of one that I drew a bearish late January to early April bearish shift pitchforks. Now, the bearish Andrews is the more steeper and is highlighted in sort of dark blue. The problem is you can't really tell the difference between the dark blue and the purple. With the market currently testing the upper time, it has been testing that today, and that's currently at 570. And the less acute bearish shift pitchfork was highlighted in purple, having the market in between the upper time above, currently at 580, and the middle time below, currently at 540. I suspect the bearish Andrews pitchfork may be key here, but I'm not concerned as to, I'm actually a bit concerned how steep it is. Additionally, though you can't see it, there is a massive crossover of tides and downtrend on or about the 20th of May. this makes me suspicious that we may have a major event around then, so watch out. Now, at the moment, the market has pushed up to the upper time, but closed on it, or just underneath it. I think it closed at 567, so we are underneath it. It'd be very interesting to see how that works out over the next week or so, and come back to it then. Chicago corn. The medium moving average, currently at 455, highlighted in mauve on my daily chart, had been an effective cap on this market throughout 2023. Most recently October, November, and then December 2023. Back then, when it was penetrated in December of last year, it still held down the market. And it has for the last 5 weeks also acted once again as a cap on any rises. Now further up, and additional to the declining medium moving average, you have the same old congestion band overhead between 490 to 498, including the 2021 low at 498. We also had for a short while the short medium moving average, currently at 401, highlighted in green on my daily chart as resistance, especially when it was entangled with the medium moving average late last year, and then later enmeshed with the now broken dark blue highlighted February 2023 to date downtrend, currently at 428. I will return to these two shortly. And going back a bit to mid-February, and prices had punched down back then, reaching the primary target 424 for the July 2023 to January 2024 descending triangle, highlighted in bright red on my daily chart. In the process, the market also punched down through the important 50% absolute Fibonacci line at 425. However, this piercing move lower was too much for the market to swallow, especially in one go, even though it also breached, though did not break, the next support below, which is the December 2020 low at 414. It's from there that we saw a strong recovery, creating a small bull channel from late February, late March, which 3 weeks ago the market broke out of on the downside and found a combination of support to seemingly base itself on. And that's at the November 2020 high at 439, plus the green highlighted short medium moving average again, and the top of the broken dark blue downtrend. I told you these two would come and feature again. 5 weeks ago I spoke on this rise, and I said at the time, and I quote, it is a significant attempt higher. As to whether it will succeed, well, that is a close run thing at the moment, but I would observe that we have not accumulated that much ammunition below, so it'll be interesting to watch. End of quote. Still mind you to think that despite the attempted V bottom in late February and the subsequent failed small bull channel, it still looks like the ammunition below was and is not enough. Not yet, at least. Though we have tended to see a more sideways move over the last 3 weeks than any reinvigorated move lower. All I can really add to this are 3 points. Firstly, I've drawn a new mid-December to late March bearish Andrews pitchfork on my daily chart. It's highlighted in purple. I'm happy to change this to a bearish shift pitchfork with a shallower bearish angle if needed, but for now this bearish Andrews pitchfork is working well, especially the upper time, which is currently at 444. Secondly, the weekly key reversal up we saw 3 weeks ago does not look like it has had a follow through higher. And finally, I repeat the same last sentence I gave 2 weeks ago, and I quote, just be mindful of target X1 below at 374. This is the secondary and much harder to reach target for the descending triangle. Kansas City wheat. A lot less going on here today than there was 4 weeks ago. However, despite a relatively narrow range, there's still a lot to see here within a fairly narrow piece of action. Not in market price movement, but in narrow piece of market angle of attack action. To explain this once more, 22 weeks ago I highlighted a feature I saw back then whilst I was looking at the price action since August 2023. It was a descending expanding wedge pattern, currently 540 down to off the bottom of my daily chart. And it's highlighted in dark blue on my daily chart. This is not the best example of such a pattern, but as I said 20 weeks ago, and I quote, does hold merit, and I would look to this pattern for some immediate idea of the move downwards, end of quote. Well, it did, until recently show the way lower. But it wasn't an easy decline, having been pierced on a number of occasions, and now seeing the market running along the top of the upper trend line and starting to pull away. During its lifetime, I've also seen the development of two new patterns, one of which involves the descending expanding wedge pattern itself. So back in early December last year, we had an attempted move higher, but it ran into the combination of the upper trend line of the descending wedge pattern and the green highlighted dynamic declining short medium moving average, currently at 581. Indeed, for a while, this pair of dynamic resistances held prices down. However, at the start of 2024, they had started to separate. And in late January this year, we saw the market head lower. Initially, I thought it might be a descending scallop pattern, but the market was and is too stretched out to be a descending scallop pattern. So instead, we still have, I suppose, a descending triangle from late November 2023 to mid-February 2024, highlighted in purple on my daily chart, with the trend lines for both crossing over early 3 weeks ago. 10 weeks ago, we had an attempted breakout below this descending triangle, but prices hesitated and have continued to hesitate, such that what I initially thought might be a triple or a quad bottom is now a quintuple bottom, looking more like a rectangle pattern in shape. Now, I'm still not sold on this idea of a rectangle here, but I can see it happening. Now, I also now note the descending medium moving average, currently at 604, now entering the frame from above, which I've highlighted in mauve. This has run in parallel and just above the dark blue upper trend line of the descending wedge pattern since it started in August last year, and also more recently with the purple upper trend line of the descending triangle. I wouldn't say it was acting or influencing as a resistance, no, not yet at least, but it has managed to perhaps have a corralling effect of some form. On the other hand, the short medium moving average in green is once again, as it has done in the past, actively engaged with the market in trying to push prices lower, though I suspect its time for flatlining may soon be coming. And I wonder then if it will carry on trying to cap the market. So for the moment, I can still lay out, as I did 2 weeks ago, some ideas below for a break lower from the descending triangle. Thus, the primary target X would be in the 539 zone, with a secondary harder to reach target X1 down in the 487 zone. I don't like the way the continuing sideways movement may have as an effect on the break below the descending triangle. I really don't like that. But I'll keep those targets below active, but for now. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Service International Limited. And here comes the final important bit.